war that Trump has waged on so many countries that we're kind of in the middle of. And so what's happening here is the market is trying to price in the probability of awfulizing that the outcome of that kind of the tariffs that we could be levying on goods and services, or goods that are coming into the country. And so the question is, and of course the reciprocal tariffs on the other side. And so you just saw this morning, we had a PPI print, a producer price index print, which was far lower than people expected on the recent numbers. And the reason for that is economists are thinking, and I tend to agree with them, is that the producers are unable or unwilling yet, or trying to not pass through those increased costs. And so, they're getting lower margins on that themselves, and possibly waiting to make orders in order to draw down other inventory they have to produce with, and wait for the confirmation that we're heading into a recession. Well, the problem is you've got the chairman of the Fed, Chair Powell, coming out and saying things like, well, we're very concerned with the impact of the tariffs. There's a tariff thing again. And so even though they're supposedly data dependent, which is what he's said for years, the Fed has said, Powell has said that they rely on data. They understand that the data may be lagging a little bit, but they rely on data in order to make their decisions. And that will impact bond prices, that'll impact the borrowing costs, that'll impact liquidity. And so the markets are trying to gauge all of that. So what you're hearing me say, and everything I've said in the last few minutes, is basically a long way of saying is the markets are trying to manage and trade around this just period of great uncertainty and issue in this country. And many other developed sovereigns have this issue. And the issue is that we spend more than we make, meaning that we don't, our real GDP is not generating enough income for the country to borrow as much as it is. And so we're running on fiscal deficits. And so that just means that we need, as the US, we need confidence in the US dollar. And that means that we need confidence in the US Treasury. Why is that? Well, foreign countries buy treasuries because they want to have something that's going to give them a rate of return that they believe is close to or above the rate of inflation. Okay. And because they need dollars. So countries around the world need dollars, and they buy US treasuries in order to have those dollars, have access to them. So when they sell a treasury, they have dollars they can use. And so you've heard over the last number of years that a number of countries have woken up to the fact that, the US inflation isn't 2, 3, 4%. It would be selling. And so traders got ahead of this. And then you've got the problem, and this is going to meander off into real world investments. You've got the problem of there's a trade out there that I've talked about that's called the basis trade. It's basically hedge funds who are long treasuries and short futures, and that are similar in duration, similar enough that they're arbitraging the difference in yield between the two. And so what they do is they take the treasury, they buy treasuries and then go and loan those out in the repo market and get cash for them. And so it's like almost a zero basis trade for them. And they short the futures against it. And so they're just arbitraging that. But this enables them to leverage it 5, 10, 20, 50, 100 times, I've heard of these trades being levered up 50 times. And so the danger there is that there's $1 trillion worth of this, like the basis trade. And then they were buying and shorting treasuries, and they were arbitraging just basis points, but they would lever it up. So even if you were making, let's say they were making, 1 basis point, if they levered it up 100 to 1, that's a full percent, right? So 10 basis points, 10%. So they were using so much leverage that when the Russian ruble was devalued and bond prices went crazy, these spreads blew out, and People heard about it. Here's the thing, and this is what's crazy about it, Scott, is that this was such a big trade. They had $1 billion worth of capital that they had levered up to what we believe was over 100 billion. So let's just call it 100 to 1, $100 billion. And they were blowing up. Now, not all this was in treasuries. This was in converts. It was in risk arbitrage, merger arbitrage ago, was the SOM rule. So Claudia Somm worked at Brookings Institution, and she did a study about unemployment and how unemployment bottoms out in a cycle. And if it starts to rise at a certain rate and gets above a certain level, which is 0.5% above the previous low, doing averages and stuff to simplify it for people, well, then it means you're in a recession. Well, the Fed uses that rule now, the SOM rule. And that came out of the Brookings Institution. Okay, so now flash forward to today, where you've got a white paper that was put out by the Brookings Institution that came up with an idea about how to deal with this massive basis trade that's out there, the $1 trillion of basis trade that's out there that could take down the street if it blew up. Well, what's their idea? Their idea is, well, instead of the Fed coming in and doing QE and printing money and buying bonds in the open market to shore up the market and say, we'll be out there buying, so we'll keep, this is called yield curve control. We'll make sure that the yields don't get out. You see that spike when there's a liquidity crisis. It hasn't happened yet. It has gone up a little bit. The average is going up, so I am watching that. And it is a concern. However, we're not there yet. So I don't want everybody to think that I'm calling that this is happening. It's not, but that's a concern. And it's such a deep concern. It's such a big concern that you had the Brookings Institution put out a white paper suggesting the Fed become a hedge fund to deal with it, which is just mental. So that's something else I'm looking at. I'm looking very closely at where the bond spreads are, where the SOFR spreads are, where the yields are, and how much demand there is in the treasury market would normally inflate to safety. But that does still happen for sure, especially on the short end of the curve. Now, where is Bitcoin and what do I see happening here? Well, remember, Bitcoin, it still has acted mostly as a risk asset for years, meaning, and I've called it the tip of the risk spear. So when you see Bitcoin moving, you know that something's happening with risk assets. Why does that happen? It often happens on the weekend because when you're a hedge fund or an institution and you see uncertainty and you see turmoil and it starts happening on Friday, Saturday, Sunday, and then you see these huge drawdowns in Bitcoin on Sundays. Why does that happen? That happens because you've got these portfolio managers that are sitting there saying, well, I'm going to get margin calls on Monday if we have this drawdown that it appears we're going to have. And because I have a levered book, so I've got to sell something to get in cash. Well, if volatility picks up, then they may require you to have 10%, 15%, 20%. And we saw this happen in 2020. And, it was really the first time in my career that I saw this happen in real time, where you had blue chip assets like Apple, Microsoft, that were a 5 or 6% haircut that jumped to 25, 30% overnight, where they required you to have more capital. Even though they weren't going down as much as that, they required you to have that much more capital in your position to cover that. And so that happens. And institutions and money managers, portfolio managers, they anticipate this now, that could happen again. And so they look for the assets they can sell. So that's why often on weekends, you see Bitcoin draw down measures that either they're expanding liquidity or contracting it. That's either by raising interest rates, contracting liquidity, lowering interest rates, expanding liquidity. QT, quantitative tightening, they're out there selling some of the assets on their books. That's quantitative tightening. That means that they're contracting liquidity. They're taking liquidity out of the market, or vice versa. QE, where they're printing money, they're out there buying assets with capital that wasn't there prior to that. So that's injecting liquidity into the markets. That's expansion of liquidity. Things like that. Things like we just talked about with volatility impacting margins. And that's not just on stocks. That's on bonds too. So when you have volatility in the bond market, then you have a higher required margin for those bonds. And so that is a contraction of liquidity. That means that money is going to be taken out. It's a very small data set to rely on for major, massive moves and investments. And so I like to take it all together and look at it holistically and kind of gauge it that way. That's my preference. I don't rely on just one indicator.
I'd love to get your take on, we've seen this year, I think, an acceleration in companies trying to emulate or compete with strategy on a Bitcoin corporate treasury strategy pun intended, and different takes. Strategy themselves have released a few different products now. They have kind of a high yield sort of bond style product. I think they have two actually.
Perpetuals, yeah. Yeah, we can talk about that. Yeah. So, I mean, look, there are a number of, everybody wants to be MicroStrategy. That's great. Love it. I love that you have companies out there who are buying Bitcoin on their balance sheet or their treasury, and they want to use that. They want to use leverage to buy more. That's great. You've seen Semler Scientific do it, and the share price would react by going up with the Bitcoin that he bought. But he soon discovered that the more correlated the stock was to Bitcoin, the more volatility there was, the more appetite there was for these convertible bonds. And the convertible bonds are bonds that can be converted into common equity. And hedge funds love these things. Why do they love them? Because you've got this bond that can be converted into the common stock. Well, that means that you own this bond. You can short the common stock against it. And in a certain ratio, it's called a delta hedge, the optimal ratio to short against it. And as the stock price goes up and down, you can be shorting more as it goes up, and then covering it as it comes down, and then shorting more as it comes up, and covering it. But you're hedged. You own this bond, and you're just short some of it through common equity, that delta optimal hedge, and you could trade around it, make money as it trades. As that stock has really kind of done an end zone run around regulators there and saying, well, we own Bitcoin on the balance sheet, but the investors want to buy our stock, and the stock is worth a lot of Bitcoin, and so that's what they've been doing. So that's more of a geographical problem they've solved. Challenge. Now you've got this new one, Cantor Equity Partners, was just announced. CEP it's a SPAC, a Cantor Equity Partners SPAC, and so they teamed up with Tether and SoftBank to create a new company called 21 that's going to be headed up by Jack Mallers. Jack Mallers of Strike. He's going to be the CEO of both companies. Well, what are they going to do? They're going to do the same sort of thing where they're buying Bitcoin and they're buying companies and creating income in order to go buy more Bitcoin. But then their ultimate goal, and they've said this explicitly, is become a Bitcoin finance company where they're going to have lending products and collateralized products around that. And so that's their ultimate goal. So it's a little bit different than what Michael Saylor has said explicitly with his company. Although, it would make sense for Michael's company strategy to be 2024. And we were hurt by this choke point 2.0, where banks just refused to do business with anyone who had cryptocurrency ties or Bitcoin ties. We had investors trying to wire us money, and the wires were canceled. They were returned. They were refused. We even had a couple of people that were debanked from their banks because they said, you're dealing with shady things, and you're no longer eligible to be a customer here. I mean, just insane stuff. So, and meanwhile, we're a Delaware registered investment fund, that is, we're completely above board. We've been doing this for 30 years in hedge funds and private equity. Everything is to the T, we're methodical and following every single SEC, and state and government rule. Didn't matter. Okay, so that was SAB 121.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.